Are you curious about investing in stocks but feel overwhelmed by the complexity of the financial world? Don't worry, we've got you covered. In this video, we'll give you a friendly and comprehensive introduction to the exciting world of stocks. Whether you're a seasoned investor or just getting started, this video is for you. So sit back, relax, and get ready to learn about the exciting world of stocks. Imagine you're running a lemonade stand, and it's an instant hit. Your lemonade is so delicious and refreshing that people are willing to wait in long lines just to get a cup. Excited by your success, you decide to expand your business by opening more lemonade stands throughout your town. But you soon realize that you don't have enough money to do it alone. Borrowing money is one option, but it means paying interest and taking on debt. So, you come up with a brilliant plan: why not sell pieces of your lemonade stand to other people in exchange for money? These pieces are called stock. When someone buys a stock, they become a part owner of your lemonade empire. If your lemonade stand continues to make more money, the value of your business and its stocks will increase. Stock represents ownership in a company. When you buy a stock, you're not just purchasing numbers that fluctuate on a graph, you're buying a piece of the company. In other words, buying a stock makes you a business owner. As a business owner, it's important to feel confident about your company's performance. One way to do this is by reviewing the financial report, which can be thought of as a report card for your business. By taking the time to analyze the report, you can gain valuable insights into how your business is performing. Although analyzing financial reports can seem intimidating, it's a skill that can be developed with practice. Fortunately, there are many resources available to help you get started. For example, our video on financial statement analysis is a great place to start. It provides an overview of the key concepts and techniques used in financial analysis, and offers practical tips on how to interpret financial statements effectively. Remember, understanding your company's financial health is an essential part of being a successful business owner. By taking the time to analyze your company's financial reports and using the insights gained to inform your decisions, you can set yourself up for long-term success. With a little bit of effort and some help from valuable resources, you can master financial statement analysis and become a confident business owner. Now, let's say you come across someone else's lemonade stand, and the owner tells you that the business makes $4 a day after paying all expenses and operates only on weekdays. That's $20 a week. If the business runs continuously throughout the year, it would earn $1,040 a year, as there are 52 weeks in a year. If the business can last for 10 years, it would accumulate $10,400 in profit at the end of the decade. Suppose the owner offers to sell you half of this business. In other words, you'll share half the profits from the lemonade stand over the next decade, but the owner wants you to give the money now. How much would you be willing to pay for it? If the business can generate $10,400 in profit over 10 years and the owner is offering you 50% ownership, would you pay $5,200 for it? Personally, I wouldn't. Why pay $5,200 to get back the same amount? It doesn't make any sense to me. Maybe the lemonade stand could do better than you think and you can get more than $5,200, but it could also do worse. Now, what if the owner offered you 50% ownership of the business for just $1? Of course, you would buy it. Only a fool would pass up such a deal. The right price, then, is somewhere between $1 and $5,200. But how much would you be willing to pay for the 50% ownership of the lemonade stand? Ultimately, it depends on how much you want to make and how cheaply the owner is offering you the deal. The cheaper he is offering it, the easier it is for you to make a decision. This is how smart investors like Peter Lynch and Warren Buffett make their decisions when buying a stock. When considering buying a stock, it's a good idea to project how much money the company might make in the future. You can do this by looking at the company's past performance and using it to make predictions about the future. Just remember that past performance can't guarantee future results, but it's still a helpful tool for making a calculated guess. As Charlie Munger famously said, it's better to be vaguely right than precisely wrong. Basically, this means that in situations like owning a business where things can be complex and unpredictable, it's better to have a general idea of what might happen rather than being too specific. This is because the information we have may not always be complete or easy to interpret. Let's revisit the lemonade stand example. Suppose you're considering investing in a lemonade stand that's projected to earn $10,400 in profit over the next decade. The owner offers you 50% ownership for $5,000, and you calculate that your 50% share of the business would be worth $5,200 in 10 years. Feeling optimistic, you invest with the hope of making a $200 profit. Unfortunately, as time goes by, new lemonade stands start popping up, creating increased competition for the business. As a result, the business doesn't perform as well as predicted, generating only $9,000 in profit after 10 years. As a 50% owner, you would receive $4,500 in profit, resulting in a loss of $500 on your initial investment. Let's consider a different scenario where you take a more cautious approach. After estimating that 50% ownership of the lemonade stand would be worth $5,200 in 10 years, you apply a 20% discount and arrive at a value of $4,160. You negotiate with the owner to purchase 50% ownership for $4,160, and the owner agrees. After 10 years, the business generates $9,000 in profit, and as a 50% owner, you receive $4,500 in profit. Despite the fact that your estimate was lower, you still managed to make a profit from your investment. When making predictions about the future, it's important to keep in mind that our guesses might not always be right on the money. That's why it's a good idea to have a safety net in place to account for any errors we might make. This safety net is known as the margin of safety, a concept introduced by Benjamin Graham, who's considered the father of value investing. Basically, the margin of safety is the difference between what a company is expected to earn in the future and the current market value of its stock. By using this concept, investors can help protect themselves from unexpected events and reduce their risk. Valuing large publicly traded corporations often involves projecting their future free cash flow. To do this, we estimate the amount of cash the company is expected to generate in the future, and then discount it using an appropriate rate that takes into account factors such as the company's interest rate, market returns, and inflation. After obtaining a present value estimate for the company's future cash flow, we divide that figure by the number of outstanding shares to arrive at a per share value. In our video on financial statement analysis, we briefly touched upon the concept of free cash flow. As we discussed, assessing a company's value requires consideration of several factors, such as its competitive position, growth potential, and management quality. We're excited to explore the topic of company valuation in more depth in our upcoming videos, so be sure to stay tuned for additional tips and insights. Smart investing opportunities can often be found in the stock market. It's common for many people to focus only on the current trend of stock prices, without realizing the true value of ownership in the underlying companies. For instance, when stock prices are on the rise, people may get overly optimistic and buy more shares, leading to overvalued prices. Conversely, when prices drop, people tend to panic and sell, causing further price decreases and undervalued stocks. However, a smart investor sees these market fluctuations as opportunities to purchase stocks from great companies at a discounted price. By analyzing a company's fundamental value, rather than just its current stock price, a smart investor can identify undervalued stocks and take advantage of the market's volatility. So, keep an eye out for these opportunities and invest. Investing in high-quality companies through the stock market can yield significant rewards, but it requires careful consideration and analysis. While we've touched on some key factors to consider in this video, there are many more that we'll delve into in future videos. Be sure to subscribe to our channel and hit the notification bell so you don't miss out on our upcoming content. If you found this video informative, please give it a thumbs up and feel free to leave any suggestions for future topics in the comments below. Thank you for watching MedDoc Invests, your partner in health and wealth. Happy investing!